Good afternoon, and welcome to today's webcast. If you would like to submit a question, you may do so at the bottom of your screen under Q&A. Please note to close other windows and programs during this webcast. Additionally, if you do experience any technology issues, please try to refresh your browser. Today's webcast is hosted by Franklin Templeton Finance Management, Brian Ward. Brian, the floor is yours.
Hey, thanks so much, Katie. And as Katie said, please ask questions throughout. It's really what makes these calls valuable, and we'll obviously try to get to as many as we can. So good afternoon. This is Brian Ward, one of the sales managers here at Franklin Templeton, and I am thrilled to be hosting what we believe, and the participant numbers do support this, will be a truly productive and informative webcast. Today's webcast is entitled Aggressive Growth and Multi-Cap Growth Q3 Update. So I'd like to first welcome, re-thank, and wish all of you and your loved ones continued safety and health. It's mid-August, and it's still so hard to fathom that we're still living through this pandemic, but we clearly are, and we wish you all well. So before we get started, I just wanted to quickly announce to all of you how exciting it is that Franklin Templeton's successful acquisition of Legg Mason was completed back on July 31st. Our newly combined organization with nearly $1.4 trillion in assets under management brings together nearly 1,300 investment professionals who will continue to offer our client firms, financial professionals such as yourselves and your clients, an even stronger level of service and an even larger menu of investment strategies to consider. And from the legacy Legg Mason perspective, you will still hear from and have a chance to invest in the same investment organizations that you've come to know and respect for their, let's say, autonomy, their independence, thought leadership, investment capabilities, etc. And today you will hear from one of those entities, ClearBridge Investments. So again, from our perspective, very exciting times for our newly combined company. So this afternoon, we are joined by two very well-known featured speakers, Richie Freeman and Evan Bauman with ClearBridge. Richie, a 44-year investment veteran, 37 of which have been with ClearBridge and predecessor names, is a managing director and portfolio manager, co-managing the aggressive growth, multi-cap growth, and all-cap growth strategies. And Evan, who brings to you over 24 years of investment experience, all of which have been spent with ClearBridge. He is also a managing director and portfolio manager and is the other side of this team, co-managing, again, the aggressive growth, multi-cap growth, and all-cap growth strategies for ClearBridge. ClearBridge Investments, I think most of you know, but is a leading global equity manager with us with over $149 billion in AUM and a 50-plus year rich history. So, gentlemen, without going backwards, so to speak, because let's face it, we could take up over an hour just talking about all the things that went on the first 6 months of 20. I mean, it's been incredible. What a 6 months it's been. But, when you look at all the volatility, disruption, and uncertainty that the pandemic has caused and brought us, if you look at like March 23rd as sort of being the bottom, or in some ways the start of a rally, which was just before quarter end, I believe, the tremendous rally, if you will, that we've seen has been incredible. Up more than 50%, I think 52% as of today to be exact, in less than 6 months. The 500 has been poised for the quickest recovery on record. We know that there seems to be some kind of a comfort level with central banks and their willingness to keep rates lower for longer. You've had this abundance of stimulus and liquidity, et cetera. I mean, this all led up to, and we've been watching for days, the S&P sort of flirting with taking out its record to actually accomplishing that with yesterday's close. So, as part of maybe, today's call, I think multiple, if not all of us, individuals would wonder, is, the strength of this market real? Is the market overvalued? Where can we go from here? So, Richie, welcome. Always a pleasure to have you on. Thought we might start with you, but before we get into any questions, we were talking earlier about, the strategies, something like aggressive growth, which has been around since the early 80s, leading into the multi-cap growth portfolio. we have some probably really true legacy holders of the product, and then some, and then individuals on here that maybe have only owned it for a few years, and you thought it might be a nice idea to talk a little bit about the history of the strategies. So why don't we start there? And welcome.
Yeah, thank you so much, and good morning or good afternoon, everybody, depending on where your locale is. I always give a great deal of thought before I do these calls. I know Evan does as well, and a lot of what the framework of what I speak about comes very often from the questions that we directly get from you. And surprisingly, we've gotten a lot of questions over the last few months about when the fund started, what kind of fund was it, how has it changed over time, talk about your thoughts about benchmark investing, etc. So I actually found the Lucite, the Aggressive Growth Fund, at that time was called the Shearson Aggressive Growth Fund, from August of 1983, when we first started to put the prospectus out. And surprising to most people, and Brian was surprised as well, what it actually says is that this fund was designed to invest mainly in small and medium-sized companies. And I think that that was the goal back then. What really has not changed, what probably would shock people, is if you look at the almost all of the companies that we have bought over the life of the portfolio, which is now 38 years, started out as small or mid. When I used to write the president's letters back in the 80s and 90s, the benchmark that we used, believe it or not, was the Value Line Index. I mean, Value Line was thought to be the broadest index. It was a good representative index for the portfolio. But we also put the Dow and the S&P, and also, believe it or not, the CPI at that time. And then as time evolved, we thought that, well, some of the stocks that we have in the portfolio started to outgrow the small or mid, names like Comcast or Genentech. And are we going to sell them just because they've outgrown the boundaries, or are we going to continue to hold them if we like the names? We made the decision to continue to hold those names. So we, I guess it was the late 1990s, Virgil Cumming, who was the boss at that time, came up with new benchmarks for all of the products and thought that we should have a Russell benchmark. And at that time, it was thought to be the Russell 2500 growth, which then became the Russell 3000 growth. Benchmark was really not that important to us at the time, because we said we took a benchmark agnostic approach. We were just going to be bottoms-up stock pickers, and there are different ways to manage money. We're just bottoms-up stock pickers. We started the multi-cap growth portfolio back in the, I guess it was probably 1992. And again, surprising to most people, it wasn't called multi-cap growth at that time. It was called mid-small cap. It only became, the name change of multi-cap growth happened because a lot of the names started to outgrow those boundaries, because we had some very, very fortunate stocks picks, as I mentioned, at Genentech or a Forest Labs or a Comcast or names like that. And we just thought it would be more representative of the portfolio to call it multi-cap growth. But our plan all along was just to try to find companies. The sweet spot for us was always small and mid-cap, and that's why our average market cap is dramatically different than what the benchmark that we have assigned is. And in all honesty, has it become a problem? On a relative basis, yeah, it's difficult when you look at being compared to something which really wasn't your mission. But again, we own the record, never make excuses. But I can tell you that I know, I'll speak for Evan, I know he has the bulk of his net worth, if not all of it, in the fund. It's by far the largest weighting that I have of any asset is the mutual fund, because I always wanted to have a portfolio, number one, that I can sleep with. Number two, at the end of the day, you never know. There are bull markets and bear markets. In a bull market, you want concepts. In a bear market, you want earnings. I always thought that you want to have companies, conceptual companies, that have earnings, and we never deviated from that at all. So Evan can talk some about the valuation parameters of the portfolio and this other things, but I think it was important to strike the note on this call, since so many people were unaware of it. This was really a small mid-cap portfolio, and I still think of it that way, where a lot of the names have obviously outgrown the boundaries. United Healthcare, Comcast, the Liberty Media companies. It hasn't changed the approach. And Evan, you want to take it, or Brian, you want to take it?
Yeah, I'll just add a few
Ev,
things.
have at it.
Brian, I know.
Yeah.
I know you had some questions, and I know there's a lot of questions coming in already about the environment, specific companies and sectors and things. But let me just add on a few of the things that I've learned in my 24 years plus now of being really honored and blessed to be working on this strategy alongside Richie since the mid 90s. I think there's a real consistency in this product, and it's as Richie made reference to, going back to the 80s. This has been a very consistent discipline, a very consistent process, philosophy, and obviously the people have been together for decades. And I think that we're going to make reference to the environment we're in right now, which that Brian, as you made reference to, I think in a lot of ways is unprecedented from a bunch of factors. But I think what's been consistent and what we're proud of, to Richie's point, is the fact that we've navigated many different market conditions since the 80s. We've navigated crashes, we've navigated bubbles. I think what we've tried to deliver to you, our clients, is a message and a process that is consistent. We're long-term investors. We're not traders, even though, if you know us, we watch the market every second of every day, including overnight. But we're investors in businesses. We've always tried to invest in profitable growth companies. We've always really been focused on the fundamentals, balance sheets, management teams that are going to grow the business over a long period of time, businesses that we believe are intrinsically undervalued in the public markets reference relative to what the business is actually worth, and companies that can generate a lot of free cash flow and grow the cash over long periods of time. I think what we've always provided, again, for our clients is non-correlated returns. We're very bottom up. We're really looking at the businesses themselves as opposed to managing to an index. And we're really, I think, one of the first lessons Richie ever taught me when I started working with him is you want to own companies that when there's significant disruption, either economically speaking or the stock market or the capital markets, and we used to say if the markets literally were to shut down for a period of time, that their businesses would be minimally interrupted. And so what does that mean? It means companies that are innovative at their core, that they're disruptive, that they have the ability to grow even when the economy is volatile or disrupted. And clearly the period that we're in right now, what we've gone through with COVID and the last, I'd say, 5 or 6 months, is in a lot of ways, it is unprecedented. This has not just been a market disruption or an economic disruption. We've had a health crisis. And so you had 3 massive crises since really the February-March time period, a health crisis that still exists, an economic crisis in a short period of time that's as bad as we've ever seen, and a stock market mini crash in the February-March time period that you referenced, Brian, which has already recovered to, as of this week, all-time highs. And I think the key is, as we kind of frame the discussion for today, we still want to own good businesses that we think can navigate this period, that are well-positioned, that are, again, I think the types of companies that can grow over long periods of time, compound earnings, free cash flow, and we're not overpaying for that. And I think that in terms of where we are today, and you should see the characteristic slide, you see what really screens today as almost a value product in terms of the metrics on a valuation basis of a lot of the companies that we own, price to earnings, price to book, free cash flow yield, that look more like a value product. But I think the key to today's discussion is still looking for growth, long-tailed growth, companies that can grow over multi-decade long time periods, and obviously, particularly in today's environment where the market has recovered, but the economic backdrop remains incredibly choppy. I think it's very important to own companies that have the durability characteristics, the IP, the ability to grow during difficult periods that we think we own. So again, just to summarize, we're long-term, we're very engaged shareholders. We tend to be top shareholders of almost every company that we own. And as Richie said, and I'll echo, we eat our own cooking. I have pretty much every dollar that's at risk in my own account is in this product. So that as we're speaking to you, our clients, just think of us as clients who are certainly invested alongside you folks as well. So Brian, why don't we just start going with a bit of interaction and Q&A?
Sure. Thanks for that backdrop, guys. I think it was important to set the stage. and to really set the overall tone of today's webcast. So, yeah, let's just touch on, like right now. So, look, you see the S&P close at its record high yesterday, coming off of its former back in February, and then everything in between. And I'll tell you, it's funny. Like if you're strictly just only following the market and you're not looking at any other piece of news, you'd feel like everything is just completely rosy. And the fact is that, depending on the state you live in, you've seen spikes in COVID. You've seen, quarantines. If you travel in one state and come home to the next, you might have to stay quarantined for 2 weeks. You have to get the COVID test done, et cetera, et cetera. So when we talk about, and one of the questions that did come up was, sort of a post-pandemic look, we don't know when that could happen. But I guess, as portfolio managers, you do have to think about the future. And so, whether it's what you've been able to look at and analyze and research over the last 6 months, and whether that leads to, what your, sectors you're most interested in today, or sectors you think would benefit after, let's say, the pandemic goes, and who knows when that'll be. Any comments there, on the portfolio? Are you posed or poised well for a post-pandemic world, and, where do you see value, et cetera? So, Ev, if you want to take that, or Richie.
Yeah, I'll start. This is Evan, and Richie, jump in. I mean, look, there's a slide up that you should be able to see that has sector exposures, and I'll reiterate that really all of the sector biases, if you will, the overweights and underweights, are really dictated by bottoms-up stock selection. But clearly, what you see with this type of strategy is some big overweights in some areas of the market that we have little or no exposure to. I mean, just taking a top-down view, I think one of the areas that, if you look at, the key sector exposures, it's healthcare, which Richie made reference to the fact we've invested in innovative healthcare businesses since the 80s, with Genentech as one of the very first holdings, actually the very first holding ever owned in the aggressive growth strategy. Which today is an interesting area to discuss. I mean, I talked earlier about the fact that we're in the midst of a healthcare crisis. You look back at the last 5 or 6 years, this is a sector that, broadly speaking, has underperformed. And there's been a lot of controversy around drug prices, around the politicizing of the healthcare industry, and obviously the potential for healthcare reform, broadly speaking. And we've always, when we talk about innovation and exclusivity and durability of growth, we've looked at companies, again, that are really unique, that are must-own, must-use products, that are treating unmet need in terms of therapeutics. And some of the businesses that we own, including Vertex and Biogen, which we've owned for almost 30 years both, have been leaders in the innovation space in terms of treating diseases like cystic fibrosis on the part of Vertex, Biogen in rare disease and multiple sclerosis, and pipelines, which we view as very exciting. I know there's questions around the neurology space, for example, for Biogen, where they could become the leader, the first company ever approved to treat the underlying cause of Alzheimer's disease. These are important markets for us. This is a space which, coming out of this health crisis, again, went into the crisis almost considered the villains in terms of drug pricing. Yet, if you look at what's happened in the last 6 months, really, since this COVID virus was just identified, and we spoke to Amgen, for example, who has spoken about the speed which with the industry has come together to find treatments, to find prophylaxis, i.e. vaccines, to prevent a recurrence of not only this virus, but similar crises in the future. I think we look at this space, which I think is still a very underappreciated area of the market, especially when you look at where valuations are relative to other areas, that we think coming out of this could actually be a leader in the market. I think it's not only therapeutics, it's prediction of disease like diagnostics, testing. We have some new companies in that space. Preventative measures, I mentioned vaccines, but preventing a recurrence not only of a crisis, but bringing back, I think, key components of the supply chain to prevent a recurrence of the extent of not being prepared for a disease like this. And we've spoken ad nauseum about precision medicine, personalized medicine, genomics, gene therapy, finding treatments for the very first time, and a lot of our companies are involved in this, in finding personalized treatments based on genomics and a genetic code to actually target specific therapies to specific patients. And some of the names like Vertex that I mentioned are directly involved in this for a number of different underlying therapeutic areas like kidney disease, liver disease, lung disease, and blood disorders. So that is a key area. I still think when you look at a number of the names that we own there trading at 9 and 10 times earnings in an environment, again, where a lot of other companies are more fully valued, if not overvalued, we think there's significant opportunity there. United Health Group we've owned since the company was annualizing at less than $600 million in revenue. Today it's over $250 billion in revenue, and a lot of their businesses are involved in analytics and bringing down costs through, again, predictive medicine as opposed to high-cost therapies at the end of patient life. So healthcare is a key area of exposure for us. I think it's broadened out a bit beyond therapeutics, but this is certainly an area for the next 10 or 20 years where we think there's great opportunity. I'll quickly move through media and tech. Communications is the biggest overweight for us. A lot of these companies have been hurt by the broad slowdown in advertising, particularly in this environment where many live events have been canceled, live sports, which are now starting to return, thank goodness. But what you've seen from Twitter, from many of our programming companies, is actually record growth in engagement in the user base, particularly those that are using the sites. In the case of the programmers, we've seen record numbers in terms of streaming users that are accessing their programming over streaming video on demand, and certainly, a company like Discovery, which has seen record ratings in its key demographics. And then the other component of that is broadband. And with the stay-at-home dynamic, as long as it's going to last, and I believe it's going to be a long time, you've seen record broadband numbers out of the cable providers like Comcast and Charter, which we have exposure to through the Liberty companies. And as advertising starts to return, I think these companies are very well positioned. The key there as well is valuations are incredibly attractive versus a lot of other areas of the market. Free cash flow yields 20+% for a lot of the programmers, and we feel like this is a very undervalued space that could see a lot of consolidation, or even some companies go private at these types of metrics, where some of the market caps of the companies that we own are trading basically at the cash on the balance sheet plus the liquidity available. Finally, I'll just talk about tech, because that's the other area where we've actually been hurt significantly on a relative basis by not owning some of the mega cap names. And that's clearly hurt, again, on a relative basis versus the index, where our active share is north of 95%. The lack of ownership of the big names has hurt. Having said that, I think when you look at 7 of our top holdings of the top 10 in the fund are actually technology stocks. So we've had good stock picking there. We focused on, again, disruptive, unique businesses that are profitably growing. Companies like Broadcom, Citrix, another major beneficiary of the work from home and stay at home environment, some of the cybersecurity companies. And then on the downside, where we've been hurt, is storage. I think some of the storage names have clearly hurt. They've clearly underperformed, yet valuations there, particularly when you look at the opportunities for growth in the cloud, in gaming, what's happening with the growth, I think, of their addressable market, which should double in the next 5 years. The need for data is growing massively. And even though there's some volatility in results, these are companies which have remained profitable through the downturn. They're free cash flow positive, and valuations, I think, are clearly overstating the worst case scenario and understating some of the growth opportunities there. We've got exposure to electric vehicles through a number of holdings, the growth of 5G infrastructure, and obviously other enabling technologies like the cloud and speech recognition as a couple of opportunities. So those are the 3 key areas of exposure that we have, and we feel like the valuations and the risk reward of what we own right now is pretty significantly outsized versus a lot of other sectors of the market.
Let me just piggyback on what Evan said. That was a great summary. Yeah, they always say the most dangerous word in this business, in the investment business, is hope. But I think we clearly are hoping for the same, everybody out there is hoping for the same thing, and that is either a treatment or a vaccine that will enable people to once again feel comfortable living a more normal life. I mean, I've never seen the medical community as united as it is right now. I've never seen the government taking steps that they are right now, allowing the companies that are developing vaccines do it at risk. In other words, develop it. If it doesn't work, you don't have to pay for it. The government will fund it for you. It's a project unlike anything since I'm alive. It's almost like the Manhattan Project was, in the 1940s. And getting it back to the stock market, the one thing that would probably upset the leadership of what's happening in the market, and leadership clearly is, companies that have benefited from stay at home. As of now, people are basically assuming it will continue until it doesn't happen. Well, I don't think you actually need the vaccine to be in people's body, but if you actually hear a credible breakthrough that the scientists are comfortable with, that this really that we've turned the corner and will allow people to live normal lives, I think you'll probably see one of the most dramatic, maybe short term, but one of the most dramatic shifts that we've seen with, some of the names that everyone's talking about, some of the companies, broadcasting and cable, where they've been throwing off massive cash flows, even in a tough environment. You're going to see a very big leadership change towards them because the valuations are cheap, and people are going to start, traveling again. They'll start going to Disney World. They'll start going to Universal Studios. They'll start, advertising is going to pick up dramatically. I think many of the companies that have been hurt will have not just a knee-jerk reaction, but I think it could be much more sustainable because you're coming off a fair market valuation. So I think that's something we all have to hope for. It's a dangerous word, but it's a first hint of something credible. I think you can see a rather dramatic change. And, you've seen a lot of companies reporting earnings over the last week or so that have been absolutely spectacular. And it's no surprise that people have been stocking up on Bounty towels and toilet paper, et cetera. I would find it hard-pressed for that to continue next year if there is a more normal environment. And money might shift out of some of those companies back towards the names which have been, I'm going to say left behind is a polite word for it.
Hey, Richie, let's just stay here for one more minute. Like, when you think back to, the first days of aggressive growth, I want to say that was in 1983. I mean, between 1983 and today, there's obviously been a tremendous amount of, disruption at certain periods of time. One thing that we get on almost every call, question-wise, is, like when you think about today and the word, unprecedented, as overused as it might be, an unprecedented period of time. I mean, like, do you agree with that, or do you see this as, just similar to maybe periods of time in the past that you've had to manage through?
I think stock market wise, you can always find some commonality. I mean, it was very similar to the crash of 1987, which was a bear market in terms of points, but not in terms of time. In terms of this being unprecedented, the two things that are clearly unprecedented, we've never had since 1918 a health crisis like this, and you've also never had a time where the unemployment rate went from 3% up to 15 or 16% within a 2-month period on a self-imposed depression. I mean, we basically put the economy into a depression by choice. That's what's been unprecedented. But in terms of the market itself, the one thing that never changes, fear and greed never change. You had, I always tell people, take a look at the investors' intelligence numbers. Anytime they get under 40, you start to buy. Anytime they get near 30% bulls, you back up the truck. Well, the same thing happened in March. You can back up the truck. It worked. Now you're getting pretty close to 60%, where invariably, it's not a low-risk juncture. A lot of people will feel much more comfortable investing in the market now because it's up a lot. I think unless you get a real big breakout in breadth, you can say that it's, there are some warning signs. But I think in terms of unprecedented, it's used, I think, a lot. This time, I think it is very, very valid. We've navigated lots of crises. I mean, go back to 9/11. That was unlike anything, thank God, we've ever witnessed. Or the crash of 1987 at that time when the market was down over 20% in a single day. That was truly unprecedented. But the one thing that the one common element that's happened over all these years is when markets have these 20 and 30% declines, invariably the markets work their way higher because the economy works its way higher. And thank God that the Fed acted proactively this time, as quickly as they could. Unlike 2008, when I think they were a little bit slow, this time they were very proactive. And I think the reason that they were acting as quickly as they did was to avoid what could have been a much more draconian circumstance. The markets which froze on March, I guess it was March 23rd or 24th, essentially were able to operate again because of what the Fed did. Now I think it's so much really depends on health and depends on getting a cure and getting a vaccine to allow people to live normal lives. That's beyond what we can tell you, but again, at the end of the day, that's I beg your pardon, that's my dog barking. Probably didn't like some of the comments I made. But at the end of the day, stocks over the long term go from the left hand go from left to right. In other words, they move higher in step functions, and the key is not to have a portfolio that's dramatically loaded with what you consider overpriced stocks where you're worried that things have to be perfect for the portfolio not to go down. That's a sure sign of risk. I'd rather own a portfolio where I feel very, very comfortable owning what I do. A company's throwing off a lot of cash flow. At the end of the day, I've learned cash flow over the long term wins. Over the short term, speculation wins.
Thanks, Rich. Hey, Ev, let's switch for a second to like the portfolio specifically. So you had started and Richie had ended with some comments on, in particular, sort of like the three key areas that you continue to like, and I heard, businesses that, have been resilient, will continue to be resilient or have resurged or will be part of a resurgence. And, when you think about the portfolio specifically, these two in particular, is there a catalyst for change that you're watching or you're expecting to sort of shift the tide for the portfolios? We hear from you and we've read, it's cheap, from a ratio standpoint, the portfolios, can you also maybe elaborate on, will your names remain cheap or, what will it take for, improvement on the valuations of the holdings on some of those names?
Yeah, and I know there's a lot of questions specifically to performance, so I'll try to wrap some of all that up in this answer and kind of also dovetail off of what Richie was talking about in terms of previous markets that might be similar. I mean, to me, it was probably March of 2000 was probably the maximum period of pressure, at least in my experience with this portfolio, to change, that we had become dinosaurs. And that was true of some of them, again, the strategies at ClearBridge that were more focused on value and free cash as opposed to price momentum and stocks that were going up seemingly daily just based purely on stock splits. And, any positive news, even some negative news, was met with 20, 30% rallies. You had a massive momentum market. I think what you've had recently in some ways is similar. Speculation since the March lows, I think where we're shocked, is for the first time really since the crisis in 2009, you've had a significant amount of speculation in the very expensive areas of the market. We spoke a bit about mega cap, but clearly right now you have an index that we get compared to, despite being almost 100% active share, where 5 names comprise 36% of the index. And you have, when you look at the characteristics page on the strategy, you look at Richie talked about being truly a multi-cap manager. We're competing against an index that now I believe has a weighted average cap north of $600 billion. So you have, the first $2 trillion company today. You have 5 names, all in the technology space, which comprise 36% of an index. And we have virtually no exposure there. And this is not an excuse, but this is really just framing the environment we've been in, where you've had tremendous performance out of the very top-heavy parts of the market. And we can debate why. I think clearly in this environment where growth managers and many managers have to get graded on a relative basis, you feel pressure to own at least some exposure to those names. And again, we try to take a very bottom-up view, but that's hurt us. And they have been great companies. This is not the bubble of 2000, but I do believe there are similarities in terms of heavy retail participation in the markets. First time I can remember since the crisis where you have a lot of retail investors bragging about how much money they've made in the last few months. And you have obviously some of the very expensive names in the market have driven the market higher. And I think that's when you look at the index returns back in March, I guess probably mid-March of 2000, the NASDAQ was dominating the returns. The Dow and the S&P were flat to down. And everybody in hindsight, knew that we were in a bubble, but I don't remember too many folks at the time discussing it other than Richie and Hirsch and some of the folks who had been through different market cycles at ClearBridge. And I think this is a similar time. The index has gotten somewhat crowded. I think there's clearly some very frothy companies in some areas of the market. A lot of those are the very kind of price momentum driven areas. And if you think about, to your question, Brian, what turns the tide? Well, no bell rang on March 10th of 2000 that flipped everything when the NASDAQ then finished down 40% for the year, the S&P and Dow led. But what tends to happen is you get not just cheap stocks, but it's value-oriented growth companies like we own. At some point, there's a clearing price for these good values. We've seen a lot of consolidation in media. We've seen it in healthcare. There was another deal today with Johnson & Johnson making an acquisition at a huge premium. And this is a strategy which historically has had I believe it's over 110 companies acquired over 37 years. We don't buy companies hoping they get bought. But when you get to a point where free cash flow yields are north of 25% and the stocks are not just cheap, they're actually growing. And I know there are questions around the growth rate on the slide. Those are consensus numbers. We expect our companies to have the ability to exceed those numbers. We have a lot of companies, for example, in healthcare growing mid to high teens, if not higher, like a Vertex. And if we're right, and that's all that we'll know in hindsight if we're right, but if we're right on the growth expectations that we have and the abilities for industries to consolidate, where the bigger companies can make a very accretive acquisition, for example, in the cable and media space of a programmer trading at 4 or 5 times earnings, even with a big premium, that can be a very positive deal. Or something in the social media space with tons of cash that's seeing record engagement that has the ability to grow significantly over the next 10 years, then ultimately the market should be, over the long term, it should be a weighing mechanism, as the saying goes. We should see, if we're buying undervalued, well-capitalized, free cash flowing growth stories, then that should be monetized. On the other end, as Richie made reference to, if you're paying, as is the case right now, 30 or 50 times sales with no underlying profits and no underlying cash flow for a company that's going up every day, well, ultimately there's no floor for a company like that. And I don't think you have the same bubble that you had then, but you do obviously have a lot of speculation in some areas of the market, and expectations for a sharp economic recovery are obviously embedded in the valuations of some parts of the market right now. So, Brian, I wish I had the answer exactly what day it'll turn or when or what event is going to turn it, but I think a combination of mean reversion in multiples, the fact that M&A is very likely, private equity money is on the sidelines right now, flush with cash, and the fact that, again, we're doing lots of work. I'm sure there are questions about new names, new industries, where we can look in the future. If we're right, then a lot of the companies that we own right now are structurally undervalued and should be monetized either, as we've always said, in the market or by other third-party entities. And there's recently really grown a lot of similarities between that period in March of 2000 and this one. And for those of you who were not invested with us back then, Richie said in 2000, if the market's up or down 1% or 2%, I'll call it a win, because at that point, the whole market was expensive. Well, the strategy had some very strong years, even without the index participating. So I don't know the day it'll happen, but I certainly believe in owning good values and intrinsically undervalued companies that are growing significantly, that are under-owned and underappreciated.
Richie, I don't know if you wanted to add to that or maybe even touch on this question. You know, I think those that have owned your portfolios over the years and maybe those on the call that are newer, you know, we clearly have a sense of the areas that you typically look at. So without necessarily naming company names, are there any other, you know, ideas or things you're looking at right now that might be deemed, you know, not yet, but maybe in the future as far as, you know, whether it's sectors or industries that you're looking at that you're, you know, like that you might participate in at some point?
Oh, absolutely. I mean, you know, one of the fun things about the business, and it is fun sometimes, is, you know, finding those undiscovered companies. You buy them early. Sometimes you have to wait, but then you get your payoff. So we monitor, to say hundreds of companies. We're not exaggerating. You know, we're not supposed to talk about inter-quarter transactions or something, but, you know, we've been adding some names, and that's, I think what's important is, you know, we're not going to change from that. There's still going to be small and mid companies we're going to be looking at, and that's the motivating factor for this business. And Evan was citing, we've been talking a lot about, you know, past cycles. We spoke about March of 2000. Number one, I'll say, I don't see the preconditions for a bear market, number one. Are there preconditions for corrections? There are always preconditions for corrections. Corrections of 5 to 10%, as we've learned, can happen in a day. But the one thing that there is something this is pretty similar what's happening right now. If you remember back in the late 1990s, Warren Buffett was so discredited. They said, well, his way is done. He's a dinosaur. He just doesn't get it. Well, people that shorted Buffett at that time, I think, made a major mistake. Julian Robertson, the best of the best. He basically pulled away from the business, I think, of managing money for people in March of 2000. He said, I just don't understand the business. And this is one of the greatest investors in history. You hear lots of calls like that right now. A lot of the smartest people have missed the rally. And has anything changed? I mean, have things permanently changed? I don't think things have permanently changed. You run into periods like this where it appears they have. End of the day, it's going to come back to, you know, cash flow is going to win. It clearly, for some of our names, it hasn't helped us. But I can't tell you how excited I am right now owning what we own. I'm speaking in the first person on this one. Nobody, and I'll say nobody, hates to do poorly versus anything more than I do. Maybe Michael Jordan, they say. But for competition, it eats me alive, and that's the strongest motivator you need. Again, from somebody doing this for a heck of a long time, if we think that we should be doing anything differently, you'd be seeing it being changing. But I think the two mistakes you can make, well, the mistake is missing some on the way up. But the biggest mistake, compounding the error, is capitulating at a point where your gut tells you it's the wrong time to capitulate, and doing the double whammy and you know, getting really brutalized on the give back, and that's something we're not doing.
That's great to hear. You know, I think we have time for one more, and you know, we tend to get this question when you're looking at an election year. And look, we all recognize that there are no crystal balls here, but you know, typically our portfolio managers will get asked, you know, when you're faced with a November election, some would argue one of the more important elections in our day, you know, are their portfolios positioned to take advantage of or possibly defend against, you know, different outcomes come the fall?
I think it's been proven to be so dangerous to try to anticipate how an election would go. I mean, look at all the people that anticipated on this election. The stock market was down. It was drifting down maybe 12 out of 13 days prior to the last election we had, and then he did a complete turnaround. I mean, the night that Trump won, the futures were down. Probably, I was speaking to Lisa Utazi, the trader, at 2:00 in the morning. Futures were down 1,000 points. People thought the end of the world. Yet the market, as we saw, did very well after that. If you would have been positioning yourself negatively on healthcare companies because the Obama administration took over and there was some negative talk about healthcare and drug companies, you would have missed one of the biggest rallies that healthcare companies, particularly United Healthcare, which went from the teens up to where it is right now. It probably got into the 200s after that, based on his administration. You would have missed some major, major moves. So I think it's very difficult to try to anticipate what happens politically. Own the right companies. Companies bail you out more times than not. It's rare you see leadership change immediately because of an election. The one time I'll differ was back when Reagan won, defense stocks started going up, and they had a massive run after that. But I think it's kind of I think it's disingenuous to your clients. Say you know the answer, you know who's going to win, and let's get our portfolio that way. Because if you're wrong, you got a lot of scrambling to do after that.
Sure. You know, look, we have just enough time. Yeah, go ahead, Ev. I was going to say, any other comments or thoughts there?
Just going to talk specifically as well to this backdrop, economically speaking, right? Because if you told us you'd have this fall off in employment and economic activity, and the most defensive sectors historically, like healthcare, would not be leading. And then you have even media, despite the advertising drop, you have some very positive fundamentals. You have what is historically a very defensive sector. You have record engagement in broadband numbers, and yet the sector has killed us this year. I mean, I'm speaking, in terms of reality. It's been a very surprising year. I think the point I wanted to make, and I know there's still a lot of questions coming in, and we want to obviously talk, about as much as we can here, but offer the opportunity. Anything we didn't talk about specifically, we are here to answer your questions. You can email us, you can call us. I mean, this is a business. I'll speak for someone who's been Richie's partner for decades. That's been built on these relationships. And so while we can't address every question on a broad call like this, we want to make sure all your questions get answered. I think we tried to hit some of the key points. Another point that I don't think we spoke specifically about, the Franklin deal, we're obviously excited by. We're going to continue as ClearBridge to remain an independent affiliate and continue to do what we do, but excited to have the parent, certainly. And we've been through a lot of deals. This is probably one we're as excited about any of the previous deals because of the strength of the parent that we're joining and the balance sheet, et cetera, as you talked about. But we don't want this to be the end. We want this to be the beginning of a discussion. If your clients have questions, email them over to us. We want to make sure that everybody gets their questions answered. And we just want, I think that, look, Brian, we've been working with you for decades. I think we've all been together for a long time, and we want that to continue. And to everybody out there that's listening, I'll speak on behalf of myself and Richie. As he said, this has been a disappointing period. We're not happy. I'm probably, if you're the number one competitive guy, I'm number two or 1A. What we're trying to give you is our best and most, current outlook on everything that we're doing. But hopefully this is just the beginning of a more further communication to make sure you're getting all the answers from us that you need. So that's all I wanted to say about that.
Richie, I don't know if you can top that. Do you have any final thoughts before we close out the call?
No, I think that summed it up pretty well. Highly motivated to get back on top.
Yeah, we know that. And so look, gentlemen, first of all, again, always a pleasure. It has been a nice run with the two of you. And, I'll speak for myself. I just love hearing you guys speak. And we hope that success follows soon. So thanks for your time. Just a tremendous amount of valuable info. Information that we hope all of you, our participants, can utilize with, your existing client base and any prospective clients. And to Evan's point, you can't get to every question on a 60-minute call. So, please continue to reach out to your local wholesalers and your local desks. We're here to help as always. And as I said, as a combined entity, I think, you're going to see the level of service and the level of thought leadership and the investment capabilities will only increase, making our conversations hopefully more productive for you. So, with that, we hope that you'll continue to look to Richie and look to Evan and portfolio experts with ClearBridge. And in fact, all of the investment managers within our Franklin Templeton universe. So with that, we wish you, your families, and your clients continued health. Please enjoy the final weeks of summer. I know school is back on track, whatever that looks like, and then Labor Day's right around the corner. So please enjoy all of that. And as I always end these calls, may the markets be with you. Thanks.
This concludes today's call. You may now disconnect.